Andean Precious Metals has transitioned from a single asset play focused on Bolivian tailings processing to a diversified North American producer with a presence in the United States. The company's pivot culminated in the acquisition and subsequent optimization of the Golden Queen mine in California, which provides a jurisdictional hedge against the historical volatility of its core Bolivian operations. In contrast, Santacruz silver mining has pursued a strategy of regional consolidation within Latin America, specifically through its acquisition of a multi-asset portfolio from Glencore. This acquisition transformed Santacruz into the ranks of major silver-zinc producers, though it initially saddled the company with significant debt obligations that were only recently extinguished in the third quarter of 2025. Andean Precious Metals, the San Bartolomé and Golden Queen pillars. Andean Precious Metals maintains its primary cash flow engine at the San Bartolomé operation in Potosi, Bolivia, which remains one of the world's most unique silver processing facilities. Unlike traditional underground mines, San Bartolomé processes surface-mined pala and sucus material, significantly reducing the capital intensity and safety risks associated with subterranean extraction. The operation has demonstrated resilience, benefiting from higher silver prices and steady plant performance that achieved a cash gross operating margin of $16.13 per silver equivalent ounce in 2025. To address concerns regarding the finite nature of these surface deposits, Andean secured agreement with state-owned Comibol in June 2025 to purchase up to 7 million tons of additional oxide ore, effectively extending the potential production runway for years to come. The acquisition of the Golden Queen, Soledad Mountain, mine in Kern County, California, represents the company's commitment to geographic de-risking. Golden Queen is an open-pit heap leach operation producing both gold and silver. While the asset faced operational challenges in 2024, including a significant fire in the secondary crusher circuit, it returned to full production capacity in 2025. Management has focused on optimizing the leach cycle, a technical endeavor that saw temporary production lags in Q3 2025 as the team reconditioned leach cells and adjusted solution application rates to mitigate fine particle migration. Despite these technical hurdles, Golden Queen remains a cornerstone of the company's future growth, with recent drilling programs identifying high-grade gold-silver intercepts that suggest substantial near-mine exploration upside.
Andean Precious Metals Asset Portfolio. San Bartolomé, surface processing of silver and gold in Bolivia. Golden Queen, open pit and heap leach extraction of gold and silver in California, USA. Comibol oxides, sourcing agreement for silver and gold ore in Bolivia. Santacruz silver mining, multi-asset complexity and sourcing flexibility. The portfolio of Santacruz silver is significantly more complex and diversified across multiple underground mining complexes in Bolivia and Mexico. The company's Bolivian operations, Bolivar, Porco, and the Caballo Blanco Group, form the backbone of its silver and zinc production. These mines are characterized by high-grade polymetallic mineralization, with the Bolivar and Porco mines being part of the Illapa joint operation with Comibol, in which Santacruz holds a 45% interest. The Caballo Blanco Group, which includes the Tres Amigos and Colcachaquita mines, has recently seen improvements in metallurgical performance following the implementation of new processing standards at the Don Diego milling facility.
A critical component of the Santacruz investment case is the San Lucas Group, which operates as an ore sourcing and trading business. This model provides the company with a buffer against operational disruptions at its own mines. By purchasing ore from third-party cooperatives, Santacruz can maintain high mill utilization and revenue generation, even when primary assets face technical challenges. This flexibility was put to the test in May 2025, when a major water inflow event at the Bolivar mine restricted access to high-grade veins. The San Lucas operation successfully compensated for a portion of the resulting production shortfall, maintaining the group's revenue resilience. In Mexico, Santacruz operates the Zimapan mine, which has benefited from substantial capital investments in 2024 and 2025. These investments focused on developing the Level 960 area and upgrading milling facilities to improve concentrate quality. Zimapan has emerged as a reliable zinc-dominant producer within the portfolio, contributing approximately 27% of total silver equivalent production in late 2025. Santacruz Silver Mining Asset Portfolio. Bolivar Mine, underground extraction of silver, zinc, and lead in Bolivia. Porco Mine, underground extraction of zinc, silver, and lead in Bolivia. Caballo Blanco, underground extraction of silver, zinc, and lead in Bolivia. Zimapan Mine, underground extraction of zinc, silver, lead, and copper in Mexico. San Lucas Group, ore sourcing for silver, zinc, and lead in Bolivia.
Andean's operational performance in 2025 was marked by a record third quarter, achieving revenue of $90.4 million and the highest earnings per share in the company's history at 29 cents. This performance was driven by the convergence of record metal prices and cost management. At San Bartolomé, mill throughput averaged roughly 4,100 tons per day, with an 85% silver recovery rate, producing 1.4 million silver ounces in the quarter. At Golden Queen, the operational narrative has been more nuanced. The mine produced 10,083 gold equivalent ounces in Q3 2025, a figure that was lower than anticipated due to leach cycle timing. The recovery of metals from heap leach pads is a time-dependent process, and any interruption in the flow of cyanide solution or the migration of fine particles can lead to temporary production lags. Despite these technical hurdles, Golden Queen's all-in sustaining costs remained well within guidance at $1,807 per gold ounce sold. Santacruz Silver's 2025 operational journey was dominated by the recovery efforts at the Bolivar mine in Bolivia. Following a significant water inflow event in May 2025, the company was forced to halt production at the high-grade Pomabamba and Nane veins. The resulting decline in silver output was stark, with Bolivar silver production decreasing by 73% in Q3 2025 compared to the previous year. To combat this, Santacruz launched a comprehensive remediation plan involving the commissioning of 5 separate pumping lines and substantial dewatering infrastructure.
By the fourth quarter of 2025, these efforts began to yield tangible results. Bolivar reported a 34% increase in silver equivalent production quarter over quarter as access to high-grade areas was progressively restored. Throughput at Bolivar increased by 22%, and silver head grades rose by 22% as the mining sequence moved back into the Pomabamba area. While access to the highest-grade portions remained partially constrained through the end of the year, the trend toward normalization is clear, with full recovery of the impacted veins anticipated by the fourth quarter of 2026. The Zimapan mine in Mexico provided a stable counterweight to the volatility in Bolivia. The mine achieved a 3% increase in silver equivalent production in Q4 2025, supported by stronger zinc head grades and consistent plant performance. This asset continues to be a cornerstone of Santacruz's Mexican strategy, particularly as the company develops the Level 960 area to enhance future metallurgical recoveries. Financial comparative analysis. Andean possesses a robust balance sheet characterized by high liquidity and minimal net debt, whereas Santacruz has only recently transitioned out of a period of high leverage associated with its rapid expansion.
Revenue and profitability benchmarking. Andean Precious Metals reported record consolidated revenue of $90.4 million for Q3 2025, representing a significant jump from the $73.7 million reported in the previous quarter. The company's profit margin improved to 24% in the same period, up from 13% in 2024, primarily driven by disciplined cost control and record realized prices of $3,448 per ounce for gold and over $40 per ounce for silver. Santacruz Silver, while also benefiting from favorable price environments, saw its net income fluctuate due to the high costs associated with the Bolivia remediation. In Q3 2025, Santacruz reported revenue of $79.99 million and net income of $16.34 million. While revenue remained relatively stable year over year, the company's AISC spiked to $35.62 per silver equivalent ounce, largely due to the extraordinary expenses incurred in dewatering and rehabilitating the Bolivia mine. However, the company's adjusted EBITDA grew by 67% year over year to $19.51 million, reflecting the underlying operational leverage to metal prices.
Financial metrics, Q3 2025 comparison. Revenue. Andean achieved $90.4 million, Santacruz reported $79.99 million. Net income, Andean achieved $43.7 million. Santacruz reported $16.34 million. Adjusted EBITDA, Andean achieved $36 million. Santacruz reported $19.51 million. Profit margin, Andean reported 24%. Santacruz reported 20.4%. Balance sheet strength and debt obligations. The contrast in liquidity is a defining feature of the two companies. Andean ended Q3 2025 with $121.4 million in liquid assets, an increase of $38.7 million from the end of 2024. This liquidity was further bolstered by the repayment of all revolving credit facilities during the first half of the year. Andean's debt-to-equity ratio remains conservative at 23.3%, and its interest coverage ratio of 51.6x is one of the highest in its peer group. This financial strength has allowed Andean to file a base shelf prospectus, qualifying the issuance of up to $200 million in securities. Santacruz's financial narrative in 2025 was one of extinguishing liabilities. In Q3 25, the company made its final installment payment to Glencore, effectively eliminating the base purchase price obligation for its Bolivian assets. This move significantly strengthened the balance sheet, allowing the company to end the quarter with $69.2 million in working capital and $59.2 million in cash and marketable securities. Santacruz's debt-to-equity ratio of 19.5% indicates that the company is now operating from a position of relative financial stability, though it lacks the sheer liquidity surplus possessed by Andean.
Cost structures and all-in sustaining costs, AISC. The cost profiles of the two companies reflect the differing nature of their mining methods. Andean's surface processing model is inherently lower cost, but subject to the chemistry of leach cycles, while Santacruz's underground mines are higher cost and subject to the physical risks of mining at depth. Andean has consistently maintained a low-cost profile at its San Bartolomé operation. The cash gross operating margin of $16.13 per silver equivalent ounce in Q3 2025 reflects the team's focus on efficiency and the benefit of processing surface material. At Golden Queen, despite being an open-pit operation, costs are naturally higher than at San Bartolomé due to the logistics of heap leaching and the scale of the earth-moving operations required. Nevertheless, Golden Queen's AISC of $1,807 per gold ounce remains competitive within the North American gold mining landscape.
Santacruz cost performance in 2025 was skewered by the Bolivar flooding event. Consolidated AISC rose to $35.62 per silver equivalent ounce in Q3, compared to just $22.34 in the first quarter of the year. This spike was almost entirely due to the $50.89 AISC reported for the Bolivar mine during the height of the remediation work. However, management has provided guidance suggesting a normalization of costs to the $22–23 range across all assets by late 2026 as production stabilizes. The San Lucas sourcing model also plays a role in the cost profile, as ore purchase costs fluctuate in line with metal prices. While this increases reported cash costs during periods of high prices, it preserves the company's operating margins. Jurisdictional and political landscape. The operating environments in Bolivia and Mexico have undergone significant shifts in 2025, presenting a complex tapestry of risks and opportunities for both companies. Bolivia is currently undergoing what some analysts describe as a dramatic political and economic transformation. The inauguration of President Rodrigo Paz in November 2025 marked the end of nearly 2 decades of socialist rule and the beginning of a pro-business centrist era. The Paz administration has signaled a decisive shift toward market openness, foreign partnerships, and robust investment protection, which is particularly relevant for the mining sector.
For Andean, this shift has already manifested in the landmark oxide ore purchase agreement with Comibol, which leverages Andean's processing capacity to monetize state-owned resources. For Santacruz, the new political climate provides a more stable backdrop for its extensive Bolivian operations and its pursuit of the Soracaya growth project. However, a historical execution and governance discount remains on Bolivian assets, as investors wait to see if promised reforms to permitting and regulation become a reality. In contrast, the Mexican regulatory environment remains challenging. President Claudia Sheinbaum has maintained a statist and nationalist approach to natural resources, including a continued moratorium on new mining concessions. While the government has ruled out changing mining legislation in the near term, it is in the process of recovering over 200 mining concessions through a voluntary process. The 2023 mining law reforms, which reduced concession terms and introduced stricter environmental requirements, were recently upheld by the Mexican Supreme Court.
This creates a regulatory vacuum for new projects, though it has not yet fundamentally altered the operations of existing mines like Santacruz's Zimapan. The recently signed Joint Action Plan on Critical Minerals between Mexico and the United States may provide some long-term benefits in terms of trade and geological mapping, but the near-term environment for mining expansion in Mexico remains restrictive.
Bull and bear case analysis. Andean precious metals, the bull case. The bullish argument for Andean precious metals is anchored in its status as a liquidity powerhouse with a clear path to mid-tier producer status through acquisition. Financial flexibility. With $121 million in liquid assets and negative net debt, Andean is one of the few junior miners capable of executing a major acquisition without significant dilution of existing shareholders. The $200 million base shelf prospectus provides the company with immediate access to capital for opportunistic deals in Tier 1 jurisdictions. Operational cash engine. The San Bartolomé operation continues to generate robust cash flows, particularly in a $75-plus silver environment. The 7 million-ton Comibull agreement removes the primary overhang on the stock, the finite mine life of the surface deposits, and positions the asset as a long-term cash generator. Safe haven jurisdiction. The expansion into California through Golden Queen provides a vital hedge against Latin American volatility. If exploration at Soledad Mountain continues to yield high-grade results, the market may re-rate Andean as a North American story, leading to significant multiple expansion. Management quality. The appointment of Johan Bouchard as president and the strengthening of the executive team in 2024-2025 has brought a higher level of technical rigor to operations, evidenced by the rapid response to leach cycle issues at Golden Queen.
Andean precious metals, the bear case. The bearish argument for Andean is centered on the risks of production decline and persistent legal distractions. Organic production decline. Analysts have forecasted that Andean's earnings could decline at a rate of 9.5% per annum over the next 3 years, with revenue growth projected to be just 2.2%. Without a successful acquisition, the company may struggle to maintain its current valuation as existing resources are depleted. The Silver Elephant Arbitration. In January 2026, an arbitrator ruled that Andean breached its master services agreement with Silver Elephant Mining Corp., ordering the payment of $1 million plus interest. While the financial impact is minimal, the ruling rejected Andean's counterclaims and opened the door for further claims related to Andean's mining activities in the Paca area. This creates a persistent legal risk and potential reputational damage. Technical sensitivity. The operational hiccups at Golden Queen in 2025 highlight the technical sensitivity of heap leach operations. Any further issues with solution chemistry or fine particle migration could lead to production misses and deteriorate investor sentiment. Concentration of ownership. A major shareholder recently sold CAD's $95.6 million worth of stock in a secondary offering. While this increases liquidity, it also signals that some insiders may view the stock as fully valued in the current environment.
The bull case. The bullish argument for Santacruz Silver is one of operational leverage and transformation. Extinguishing debt. The payoff of the Glencore consideration is a transformative event that materially strengthens the balance sheet and frees up significant cash flow for exploration and development. The Soracaya Catalyst. Soracaya is emerging as a cornerstone growth project in Bolivia. With high-grade resource modeling already supporting a preliminary mine plan, Soracaya has the potential to add 4 million ounces of pure silver production annually, representing a massive organic growth engine. Recovery momentum. The 9% quarterly production growth in Q4 2025 signals that the worst of the Bolivar flooding is over. As access to high-grade Pomabamba and non-A veins is fully restored in 2026, Santacruz is poised for a dramatic increase in silver production and a corresponding decrease in AISC. The San Lucas Buffer. The ore sourcing model provides Santacruz with a level of operational flexibility that its peers lack, allowing it to remain profitable and revenue resilient even during major mine site disruptions.
Santacruz. The bear case. The bearish argument for Santacruz focuses on high operational costs and the technical risks inherent in its multi-asset portfolio. Elevated cost profile. Santacruz's consolidated AISC remains significantly higher than that of its peers, reaching $35.62 per ounce in late 2025. While management expects normalization, any technical setback in the dewatering process or subterranean mining could keep costs elevated and erode profitability. Technical fragility.
The Bolivar flooding event demonstrates the vulnerability of underground mines in certain Bolivian geologies. A recurrence of such an event would be catastrophic for the company's share price and credibility with institutional investors. Jurisdictional concentration. Despite having operations in Mexico, Santacruz is heavily reliant on Bolivia for its revenue and growth. While the Paz administration is pro-business, any shift back toward populist policies or local social unrest could significantly disrupt the company's primary assets. Valuation multiples. Trading at an EV to EBITDA of 10.5x, Santacruz is valued at a premium to many of its peers, suggesting that the market has already priced in a significant portion of its recovery. Any disappointment in the Q1 2026 production results could lead to a rapid re-rating to the downside.
Comparative technical valuation. To accurately compare the two entities, one must look at the replacement value of their assets and their geological potential. Andean's San Bartolomé is a high-margin processor, while Santacruz's portfolio is a collection of high-grade underground mines. Reserve and resource benchmarking. Proven and probable, 2P, reserves, San Bartolomé has an estimated 4.6-year mine life, while Santacruz's Bolivar mine contains 27.2 million silver equivalent ounces. Measured and indicated, M&I, resources, Andean holds 6.1 million tons at 98 grams per silver at San Bartolomé. Santacruz reports 40.7 million silver equivalent ounces at Bolivar. Inferred resources, exploration is ongoing at San Bartolomé. Santacruz reports 111.3 million silver equivalent ounces at Bolivar. Recovery rates, silver, Andean achieves 85% at San Bartolomé, while Santacruz achieves 89.7% at Bolivar.
Note: San Bartolomé mine life is based on 2023 estimates and was extended via the 2025 Comibol agreement. The geological upside for Santacruz is arguably greater, given the massive 111 million ounce inferred resource at Bolivar and the 4 million ounce per year potential at Soracaya. However, Andean's ability to manufacture mine life through strategic agreements and heap leach optimization provides a more predictable production profile for risk-averse investors. Exchange rate impacts, the adoption of IAS 21. A subtle but critical financial differentiator in 2025 was the adoption of a new exchange rate methodology by Santacruz for its Bolivian operations. Starting January 1, 2025, the company replaced the fixed official rate of 6.96 BOB per USD with a market-based spot rate averaging 12.20 BOB per USD. This adoption of IAS 21 allows for a more accurate reflection of the economic reality on the ground and has provided a structural cost advantage as the Bolivian peso, Boliviano, suffers from devaluation. While the appreciation of the Boliviano in late 2025 increased some USD equivalent costs, the overall shift toward market-based rates enhances the transparency and reliability of Santacruz's financial reporting for international peers.
Conclusion. The comparison between Andean and Santacruz reveals two distinct paths to capturing the silver market's current upswing. Andean Precious Metals is for risk-conscious investors who value balance sheet strength, geographic diversification into the United States, and the stability of a surface processing model. While the silver elephant arbitration is a nuisance, the fundamental earnings power of San Bartolomé remains undiminished. Santacruz silver mining is for investors who seek high beta exposure to a massive regional recovery. The extinguishing of the Glencore debt and the rebound of the Bolivar mine are catalysts that could drive significant share price appreciation in 2026. However, this path is fraught with higher technical risks and the operational complexities of underground mining in challenging environments. Ultimately, the divergence in their valuation multiples, with Santacruz trading at a premium EV/EBITDA of 10.5x compared to Andean's 8.0x, reflects the market's current appetite for Santacruz's turnaround story over Andean's fortress story. As the 2026 silver deficit deepens, both companies are well-positioned to reward shareholders, provided they can continue to navigate the localized technical challenges that define the mid-tier precious metal space.